Robert had more money at 74 than he had ever had in his entire life. The account balance was the highest it had ever been. His investments had recovered from every dip. His monthly withdrawals covered everything. The mortgage was paid off, the kids were through college, the vacation they had been postponing for 15 years had finally happened. By every measure, he understood. He was winning. He was also, technically, breaking the law, and he had absolutely no idea. The mistake Robert was making had nothing to do with fraud, nothing to do with bad investments, risky decisions, or financial irresponsibility. He was not hiding money. He was not avoiding taxes intentionally. He was simply not withdrawing enough. At age 73, the United States government requires every holder of a traditional retirement account to withdraw a specific minimum amount every year, whether they need the money or not. Fail to take that withdrawal, and the IRS imposes a penalty. Under current rules, that penalty is 25% of the amount you should have withdrawn. For Robert, across 2 missed years, that number came to $22,800. Not a fine for doing something wrong. A penalty for not doing something most people don't even know they're required to do. This is the quiet RMD mistake. It doesn't announce itself. There's no warning email, no automatic notification, no phone call from your account custodian. It accumulates in silence, one missed year, then another, until the IRS calculates what you owe and sends you a letter that makes most people sit down. In this video, I'm going to show you exactly how it happens, why it keeps happening to people who did everything else right, and, more importantly, the 4 strategies that turn required minimum distributions from a tax trap into one of the most powerful planning tools available in retirement. The second half of this video is the part most financial channels never cover. Stay with me. Before we go further, let me explain what required minimum distributions actually are, because the name is more confusing than the concept. Every dollar you contributed to a traditional 401k or traditional IRA during your working life came with a tax deduction. You did not pay income tax on that money when it went in. The government agreed to defer that tax, but it never forgave it. Required minimum distributions are the mechanism the government uses to collect. Starting at age 73, the IRS requires you to withdraw a minimum amount from your pre-tax retirement accounts every year. You pay ordinary income tax on every dollar withdrawn. The schedule is fixed. The calculation is your responsibility, and the penalty for missing it arrives without warning. The penalty used to be 50% of the missed amount. Recent legislation reduced it to 25%, and to 10% if corrected promptly. But even 10% on a $40,000 RMD is $4,000 for a paperwork oversight in a single year. The problem is not that people haven't heard of RMDs. Most people have. The problem is that there are 3 specific things about how they work that almost nobody explains clearly, and each one is responsible for a different category of expensive mistake. Robert retired at 70 after 31 years as a hospital administrator. On his last day, HR handed him a packet. RMDs were mentioned in a footnote on page 11. He rolled his 401k into an IRA at his bank. The bank set up the account. Nobody mentioned that the RMD clock, paused while he was still working, would restart at 73, exactly 3 years away. At 73, Robert received no automatic notification. His IRA custodian was not legally required to calculate his RMD or remind him to take it. They were required to report his account value to the IRS. The calculation and the withdrawal were Robert's responsibility entirely. He didn't know that. His first RMD should have been $32,500, calculated by dividing his prior year-end balance by a life expectancy factor from an IRS table he had never seen. He missed it. His second should have been 34,200. He missed that too. When the notice arrived, he owed penalties on 2 years of missed distributions plus back taxes on the amounts themselves. He spent 6 months believing he had done something seriously wrong, that there had been fraud somewhere, a filing error, a mishandled rollover. There hadn't been. He had simply never been told how the system worked. He is not alone. He is, statistically, the majority. Here are the 3 specific things about RMDs that most people get wrong. The first, not knowing when the clock starts and when it restarts. The RMD starting age has changed multiple times. It was 70 and a half for years. Then legislation moved it to 72. Then to 73 for people born after 1950. For people born after 1960, it will be 75. If you received advice about RMDs more than 3 or 4 years ago, check the current rules. They may have changed since then. There is also a specific exception that trips up a significant number of people. If you are still working at 73 and actively contributing to your current employer's 401k, you can delay RMDs from that specific plan until you retire. This is called the still working exception. It sounds broad. It isn't. It applies only to your current employer's plan, not to old 401ks from previous jobs, not to IRAs, not to any account other than the one tied to your current active employment. Robert had rolled his 401k into an IRA at retirement. The exception did not apply. The clock started at 73 regardless. The second, miscalculating the amount. The calculation seems straightforward. Take your account balance at December 31st of the prior year. Divide by your life expectancy factor from the IRS Uniform Lifetime Table. The result is your minimum withdrawal for the current year. 2 things make this more complicated than it appears. If you have multiple traditional IRAs, you can aggregate their balances and take the total RMD from any one account or any combination. Simpler. But if you have multiple 401ks from different employers, each requires its own separate RMD calculation and its own separate withdrawal. You cannot aggregate them the way you can with IRAs. This distinction catches a surprising number of people. The second thing almost nobody knows. If your spouse is more than 10 years younger than you and is the sole beneficiary of your IRA, you use a different life expectancy table, the Joint Life and Last Survivor table, which produces a lower required withdrawal and a lower tax bill every single year. The difference for a 75-year-old with a spouse who is 60 can be $3,000 to $5,000 less in required withdrawals annually. That is $3,000 to $5,000 less in ordinary income tax, compounding over years. Most couples who qualify for this are using the wrong table. The third, treating RMDs as an obligation instead of a tool. This is the most expensive mistake of the 3, and it never shows up on a penalty notice. Most people receive their first RMD calculation, take the minimum required amount, pay the tax, and move on. They treat it as a nuisance to be managed, a tax burden to be minimized, something that happens to them rather than something they can shape. The people who handle RMDs well think about them completely differently. They see each annual RMD as a forced withdrawal that creates a planning opportunity, a chance to rebalance the portfolio, fund a Roth conversion at a predictable tax cost, eliminate the tax entirely through charitable giving, or time the withdrawal to minimize the bracket impact for that year. Each of these approaches is legal. Each is well documented. Each can save thousands of dollars per year, and each requires deciding, before December 31st, to treat the RMD as an active financial decision rather than a passive one. Subscribe before we go further. We cover this level of detail every week, and what comes next is the part most financial channels skip entirely. Before we continue, I am not a financial advisor or tax professional, and everything on this channel is based on research, analysis, and stories like Robert's, not professional credentials. RMD rules are complex, change frequently, and interact differently with every individual's tax situation. Please consult a qualified financial advisor or CPA before making any decisions about your required minimum distributions. Now, let's continue. Here are the 4 strategies that turn RMDs from a tax obligation into a planning tool. Strategy 1. The qualified charitable distribution. If you are 70 and a half or older and you plan to make charitable donations anyway, there is a mechanism that allows you to send money directly from your IRA to a qualified charity, up to $105,000 per year, and have that amount count toward your RMD without it ever appearing as taxable income on your return. The distribution satisfies the RMD. The money goes to charity. You receive no charitable deduction, but you also pay no income tax on the withdrawal. For someone in the 22% bracket, with a $30,000 RMD who was planning to donate $15,000 anyway, this is 300s in federal tax savings in a single year. It is one of the most tax-efficient strategies available to retirees over 70 and a half. It is legal, straightforward, and almost universally underused, because nobody explains it at the right moment. Strategy 2. Roth conversion before RMDs begin. Every dollar you convert from a traditional IRA to a Roth before age 73 is a dollar that will never be subject to RMDs. Roth IRAs have no required minimum distributions. A smaller traditional account balance at 73 means smaller annual RMDs, a lower bracket in retirement, lower Medicare premiums, and more flexibility in how and when you spend. Robert had $890,000 in his traditional IRA at retirement. If he had spent the 3 years between retirement and 73 converting $40,000 per year to a Roth, paying 22% on each conversion, he would have reduced his RMD obligation by approximately $4,500 per year for the rest of his life. The tax paid on the conversions would have broken even in under 6 years. Everything after that, pure savings. The window to do this is between 59 and a half and 73. It is the most underused planning opportunity in retirement finance. Strategy 3. Timing the first RMD and avoiding the trap. There is a one-time option for your very first RMD. You can delay it until April 1st of the year following the year you turn 73. More time. More flexibility. It sounds like a benefit. For most people, it is a trap. If you delay your first RMD to April 1st of the following year, you must still take your second RMD by December 31st of that same year. 2 full RMDs in 1 calendar year, both counted as ordinary income. The combined amount frequently pushes retirees into a higher tax bracket, triggers IRMAA Medicare surcharges, and increases the taxable portion of Social Security. The apparent benefit of delay creates a tax spike that costs more than it saves. The general rule: take your first RMD in the year you turn 73. The April 1st option exists for specific circumstances where income will be significantly lower in the following year. For most people, on time is the right answer. Strategy 4. Consolidation before the clock starts. If you have multiple traditional IRAs, consider consolidating them before RMDs begin. Fewer accounts mean a simpler annual calculation, less chance of missing a required withdrawal from a dormant account, and lower administrative complexity. If you have old 401ks from previous employers sitting in separate accounts, rolling them into a single IRA gives you more flexibility, potentially lower fees, and the ability to aggregate your RMD calculation across all IRA balances, which simplifies the annual process significantly. Arrive at 73 with a clear, consolidated picture of your pre-tax assets, not a collection of accounts from different employers, different custodians, and different sets of rules that each require separate management. Robert, after the IRS notice, found a retirement income specialist, not a general financial advisor, but someone who worked specifically on distribution planning. In their first meeting, the advisor identified 3 things Robert had been doing suboptimally. He was using the standard life expectancy table, but his wife was 12 years younger than him, which meant he qualified for the joint table and had been overpaying his RMD by approximately $3,800 per year. He had been taking his full RMD in January each year, creating unnecessary income concentration in the first month. And he had $23,000 in annual charitable giving that could have been structured as qualified charitable distributions, saving him roughly $5,060 per year in federal taxes. None of these were errors. None were fraudulent. They were simply less efficient than the available alternative, and nobody had pointed them out at the moment when pointing them out would have mattered. After the changes, lower annual RMD, lower bracket, lower Medicare premiums, same charitable giving, approximately $8,800 more per year in after-tax income. The penalty Robert paid to the IRS was the most expensive lesson of his retirement. It was also, eventually, the most valuable one. Here is what this video is really about. Required minimum distributions are not complicated. The rules are published. The tables are available online. The arithmetic is straightforward. The reason 84% of retirees make at least one significant RMD mistake is not that the information is hidden. It is that the system is designed to be navigated, not explained. Your IRA custodian will report your balance to the IRS. They will not calculate your RMD. They will not remind you to take it. They are not required to. The responsibility is yours entirely, and the penalty for getting it wrong arrives without warning, on a Thursday afternoon, in an envelope you were not expecting. Robert was winning by every measure he understood. The measure he didn't understand was the one that cost him $22,800. The difference between his situation and the situation of someone who handles this well is not intelligence. It is not financial sophistication. It is knowing before 73 what the rules actually are, and making 1 or 2 quiet decisions that change the outcome for the rest of retirement. You now know the rules. The decisions are yours to make. Here is where to start. If you are within 10 years of 73, run your RMD projection now. Take your current traditional IRA and 401k balances, project them at 6% annual growth to age 73. Divide by 26.5, or by the joint life factor if your spouse is more than 10 years younger. That is your estimated first RMD. Add projected Social Security. If the total pushes you into the 24% bracket or above, you have a window to act, and the Roth conversion strategy is where to start. If you are already past 73, verify you are using the correct life expectancy table for your situation. Confirm you are taking separate RMDs from each 401k. They cannot be aggregated with your IRAs. Review whether any portion of your RMD qualifies for a qualified charitable distribution if you make regular donations. If you have multiple old 401ks, consider rolling them into a single IRA before your RMD starting age. The simplification alone is worth the effort. The potential tax savings on top of that make it one of the highest return administrative decisions available to most retirees. Tell me in the comments, did you know about the joint life expectancy table before this video? And if you are already taking RMDs, is anyone helping you think about these strategies, or are you doing it alone? I read every single comment. Subscribe. Because next week, we are covering the Rule of 55, a specific provision buried in the tax code that allows certain people to access their 401k before 59 and a half with no penalty at all. Most people who qualify have never heard of it, and understanding it changes the retirement math for an entire category of early retirees.